This line shows the difference between long-term and short-term yields. In late 2006, it started heading down, and when it went below the yellow line in 2008, it became inverted. And this happened.
Dow tumbled more than 500 points after two pillars of the street tumbled over the weekend.
Lehman Brothers has filed for bankruptcy. Stocks all around the world are tanking because of the crisis on Wall Street.
We are in the midst of a serious financial crisis.
Now in 2018, we're heading down towards the yellow line again. The inverted yield curve has predicted all three recessions since its correlation was discovered in 1991, in 2000 and 2001, and the global financial crisis in 2008. The professor who discovered it says that there have been no false predictions yet. Does this mean that we're going to have another recession? When people talk about yield curves, they're talking about how much they get paid to hold bonds for various lengths of time. Bonds are essentially loans, say to the US government, that mature or come due at some point in the future. A yield curve plots the rate you get paid for each of the holding periods.
My name is Keith Morris. I have been in the financial services business for almost 40 years now. Typically, you would have what's called a positive yield curve. You theoretically want to get more interest return out in 30 years than you do in 1 year, 6 months, 5 years, 10 years.
The longer the bond issuer has to pay you back, the more time there is for things to go wrong, and the more you should be paid. The yield curve that economists like to talk about is the comparison of returns on US Treasuries of different maturities. 3 months, 2 years, 5 years, 10 years, and 30 years. A normal yield curve shows more yield the further out you go, just like you'd expect. But an inverted yield curve shows the opposite.
An inverted yield curve is really interesting in that it doesn't happen very often. Probably happened half a dozen times, so called 6 times over the last 15 or 20 years. And each time we have had a recession, I want to say each time except for one, we have actually had a recession afterwards.
An inverted yield curve is when bonds that mature in the short term start to yield more than the ones that are due 10 or 30 years out. This happens because people, worried about the government's ability to pay back loans in the near future, demand higher payout rates to hold that debt.
The inverted yield curve by itself does not necessarily mean you're going to have a recession. But it is an indicator that there are people very worried about the future and think the future is going to be weaker than the current time.
Right now, the yield curve is flattening, with the difference between long and short-term yields returning to the very low levels that it hit in 2006, which came before the financial crisis a decade ago. A full inversion may be on its way. That doesn't necessarily signal that recession is imminent. Historically, a yield curve inversion comes 18 months to 2 years before the economy goes south. Although the relationship is sound, people don't always use the yield curve the right way. Campbell Harvey, a professor of finance at Duke University who discovered the correlation in 1986, says that right now, the media is wrong because they're not using his model correctly. The media has been using the difference between 10 and 2-year bond yields as a reference point, but Harvey says the right relationship to look at is the difference between 5-year and 3-month yields. That is currently positive, and Harvey says it would have to go negative for a full quarter before it indicates a recession.
Having been in the bond market for almost 40 years, you can't predict anything with one indicator, right? I mean, it just doesn't make any sense. You have to look at employment. You have to look at wage gains. The yield curve's one of them. You have to look at the global economy these days.
Inverted yield curves are just one piece of the puzzle that is economic predictions. It's not the new fear gauge. It's just another tool in economists' pockets. Of course, the question isn't if another recession is going to hit, it's when. But inverted yield curves alone aren't going to show you the big picture. So take it with a grain of salt. It's just another way that economists look at the market. As President Ronald Reagan once said, if Trivial Pursuit was designed by economists, it would have 100 questions and 3,000 answers. Do you think that we're in for another recession? Leave a comment, throw us a like, make sure you subscribe, and click the bell if you want to know whenever we post a video.